Thank you for joining us today. In the next few minutes, I would really like to share with you our outlook for 2014 and where we currently do see investment opportunities. I think if we look at 2013, it's been a better year than most people expected. On the equity market side, many markets returned double-digit returns. And on the economic front, a lot of regions actually moved out of recession and started contributing to global economic growth. What we are seeing at the moment is a much broader and synchronized recovery taking place. That is very good because all of that is underpinning company profitability, and that is what we are very much interested on behalf of you, our clients. If we then go around the world and we take the different regions, let's start with the US. They're definitely winning the race at this point in time, and we do expect that in 2014 they're likely to get back to their long-term trend growth. That's about 3 to 3.5% at this point in time, over and above inflation. If we think about the US consumer is the biggest driver behind economic growth, and the US consumer is getting healthier and happier. That is once again very good in terms of supporting growth and supporting company profitability. Let's drill a little bit into that. If you think about the US consumer, currently there are more US consumers because they are actually creating more jobs as we speak, and the unemployment rate is dropping fast. These consumers are also in a position where they've paid back a lot of debt, and they're once again in a position where there's an appetite for credit. An appetite for credit is always good because that means more people going out, more people spending, supporting demand, and once again supporting company profitability. If we think about what's been happening in the US last year, especially around the government, there's been a lot of negative news in terms of the government shutdown and also questions about the sustainability of debt levels. We are not really concerned about that. The way we look at it, we are saying, well, if the economic recovery continues, government is likely to collect more taxes, and as a result of that, the reliance on debt is getting smaller and smaller, and this is not really a long-term problem and should be sustainable going forward. So we really think the US is back on trend, and they're getting back to a growth rate, like I've said, to 3.5%. If we then turn to China, the second biggest economy in the world, then there's a lot of concern about a hard landing. And that's largely on the fact that China's not growing at 10% anymore, but closer to about 7%. The way we look at it is to say, well, we don't see a hard landing, we don't see a property bubble or a credit bubble. The 7% growth that China is turning out at this point in time is probably the right rate for a maturing economy. They've been industrializing for many years, and they're now in a position where they transition from an infrastructure development and exporting economy to consumer-based economy. As a result of that, going into 2014, there will still be some challenges that they face, and we are seeing growth for this year somewhere around 6.5%. Yes, 6.5% is not the 10% growth that we've got used to, and therefore we also don't think that it's the right underpin for another super cycle in commodity prices. But 6.5% is still significantly more than other parts of the world. Still healthy demand for a lot of commodities around the world, and therefore we do think there will be an underpin for commodity prices where they are currently. We then just look at Japan. Japan's been an economy that's been in deflation for the past 10 to 15 years. Since the beginning of 2013, they had a change in leadership. As a result of that, many policy changes took place. It's still early days, but it does seem that there are some good progress taking place in Japan. Economic growth is quite robust, inflation is moving in the right direction, and therefore we do expect a lot of that might continue this year, although it might be slightly softer coming off a very high base of 2013. Also, right now they're in a position where they're talking about lifting the value-added tax, which is a good thing because it does indicate that the government is happy that the economic growth is strong enough and that they can do that to reduce their government deficit, but that is likely to put a bit of a damper on the current momentum in economic growth. As a result of that, we do think Japan this year can grow somewhere between 1 and 2%, and again, it's another part of the world contributing to a more balanced and synchronized global economy. Turning to Europe, that is the one part where we're still slightly concerned. Yes, they emerged from recession in 2013. Consumers are picking up their heads, manufacturing is doing better, but it's still a big difference between Northern and Southern Europe. If we think about some of the challenges, there's still massive challenges in terms of competitiveness, especially between North and South. Huge unemployment in the South, very, very soft inflation, and very much still an environment where we're rather concerned about deflation and the potential impact deflation might have on longer-term growth in Europe. In Europe, currently, there's also no demand for credit. In fact, there's negative credit growth, which means that the consumer is under pressure or they're not willing to spend, which is another way of saying that deflation is probably a longer-term problem for that part of the world. And therefore, as a result, we think Europe as a whole is likely to only grow somewhere between 0.5 and 1% this year. If we then turn to emerging markets had a lot of turmoil during 2013, some of that's continuing in 2014, but still we do think that emerging markets is not in a position where we were likely to see another emerging market crisis. Most of the countries have much lower external debt requirements, higher currency reserves, lower interest rate payments, and in most cases they're running surplus accounts and not negative current account deficits. As a result, they're likely to stomach a potential sell-off in currencies more compared to about 10 or 15 years ago. Unfortunately, that's not the same for all emerging market countries, and there are some of those that are more exposed than others. But if we look at the region as a whole, we do think they can grow this year around about 4 to 4.5% over and above inflation, which is slower compared to the history and the numbers that we've got used to, but it's still probably double the growth that we will see from developed markets. If we then turn to South Africa, we're part of the emerging market space, but unfortunately we are one of those that are probably more fragile. We currently have a twin deficit, meaning that we're running a deficit on the current account and also on the government side in terms of their expenditures versus the income, and that puts us on a much more vulnerable spot compared to other emerging markets. On top of that, during 2013, we've seen a lot of negative headwinds in terms of sentiment, all the striking activity taking place in South Africa, the impact of that on manufacturing and mining. And then also the consumer is a very important role player in the South African economy. And at this point in time, we do see a two-speed consumer. We've got the high-income consumer doing fairly well, and as a result of them underpinning consumer spending. But despite that, consumer spending is still at a 5-year low. Then on the other hand, we see the low-income consumer, they're more under pressure. We do see the underpin of credit falling away. Government is supporting less on that side of the consumer base, and also that's the consumers that's been influenced by less pay in all the strike activity that took place. As a result of that, we are slightly concerned about the local economic fundamentals. We do think the rand is likely to remain under pressure in this kind of environment. We will get a benefit from global economic pickup. We already see that with a weaker rand in terms of better export numbers, and that over time will address the huge current account deficit. Unfortunately, our imports remain sticky, and therefore this year will still be a challenging environment for South Africa. As a result of that, we see economic growth in South Africa somewhere around 2.5%, and that might even be on the positive side. If we then take all of this and summarize, and we think global growth for 2014 is likely to be somewhere between 3 and 3.5%. With global growth around about 3 to 3.5%, that is actually a good environment for most companies to maintain profitability and in some cases even increase profitability. So for us, it's all about the potential of generating free cash flow, because that's what we, on behalf of our clients, are interested in buying. So we are saying in this kind of environment, companies will still be able to generate free cash flow. And yet then if we look at what do we pay today for that cash flow, then in most regions it is below the long-term average, and in many cases it's still at a reasonable discount, despite the fact that most markets since 2009 had a reasonable increase. So we tend to still overweight global equities in most of our client portfolios. Then if we look at what's been happening in emerging markets during 2013, most of those markets are now trading at a very handsome discount relative to developed markets, and therefore we also try to overexpose our clients to some of those markets. South Africa, like I've mentioned, we're slightly concerned about the local fundamentals, yet if we look at the Johannesburg Stock Exchange, we are seeing very stretched valuations. So as a result of that, we started taking some profit in terms of our South African exposure, and we are making sure that the South African-based portfolio will be tilted towards those sectors where we still do see some significant value or upside, and we're selling or taking profit from those sectors where we do feel they're quite expensive compared to alternatives globally. Then lastly, maybe on the fixed income side, given the fact that we see the global economy moving into a space where the Fed already started moving some of their stimulus, and soon within the next 18 months we're likely to see interest rates moving higher in the developed markets. We tend to stay away from any asset class that's sensitive to changes in interest rates. So we're very light on government bonds around the world, especially in developed markets, and assets at this point in time like listed property. Thank you very much for your time. Until next time, goodbye.